Hello and a very warm welcome to Econoday Unplugged and what is our first podcast of 2023. Terry Sheehan's on the US East Coast, Max Sarto's in British Columbia, Brian Jackson's in Sydney, and I'm Jeremy Hawkins in London. If you're in the forecasting business, then 2022 was almost certainly a year that you'll be more than keen to forget. Soaring inflation, aggressive central bank tightening, and the worst synchronized slump in bonds and stocks in half a century left a lot of egg on a lot of faces. But as we move into 2023, the economic outlook is hardly any clearer. The war in Ukraine rages on. Interest rates are still generally headed north, even though most of the impact of last year's hikes has yet to be realised. Quantitative tightening is being stepped up. COVID is still mutating and remains a serious threat in at least some parts of the world. And political relations between the East and West are the most strained in a generation. Importantly, too, on the supply side, investment in natural resources remains inadequate. So perhaps it's not too surprising then that according to the folks who construct the Global Policy Uncertainty Index, the new year starts with uncertainty levels around the highest on record outside of the first COVID wave. Still, while attempts to forecast 2023 should probably be taken with more of a bucket than a pinch of salt, it remains important to at least identify the issues most likely to determine how regional economies, policies, and financial markets will perform this year. And that's what we'll be aiming to do in today's podcast. So, kicking off then, as usual, with the US and Terry. US Treasuries made their strongest start to a year since 2001. It seems in large part due to market speculation, despite what the Fed itself might be saying. Official interest rates will be on their way down before year end. So, what should we be watching to get a head start on who's right and who's wrong?
Well, at this point, I believe the Fed policymakers over the market. We've been getting the start of the year speeches, and the consistent message is that inflation is still much too high and the Fed is not done its work raising rates. So I think the other thing that they do say, though, is that the Fed is data dependent. So should the tone of the economic data change, then the direction of monetary policy will as well. But at this point, my bets would be on another series of at least two or three rate hikes of 25 or 50 basis points, and no reduction in rates before year end.
Okay, fair enough. I guess as far as a lot of the market's concerned at the moment, as mentioned, some of the futures markets clearly looking for the Fed to begin lowering interest rates towards the back end of the year. So I guess what the key question for investors is going to be: what's going to matter most in 2023? Is it still the case really simply focusing on the inflation indicators or leading indicators of price pressures or that sort of thing, or do you think the real economy, particularly we do get the slowdown that in some shape or form most people are anticipating, is going to become more important on the policymakers?
Well, I think what we're seeing in the data right now suggests that we're actually going to exit 2022 with a relatively solid performance in the quarter. But all the most current indicators suggest that consumer confidence is falling, that there's no immediate sign of relief in the kinds of inflation that affect U.S. households' non-discretionary spending too much yet, and that the U.S. economy is slowing down. So I suspect that at least the first quarter 2023 is going to be a very soft one.
Okay, fair enough. If not about the household sectors, I guess one of the key driving forces behind what happens to US GDP this year is going to be what happens to private sector spending. And we've had this, this huge gap in terms of recovery between what's going on in services, which has been pretty sluggish, and particularly consumer durable spending, which has recovered extremely rapidly. Now, do you think that gap is going to close as we go through this year? And if it does close, is it going to be the case that we're going to have a sort of a slowdown and perhaps some weakness in durables and a pick up in spending? Or I guess, bottom line to all this is, what's the implication going to mean for overall consumer spending and hence GDP as we go through the December time?
Well, I think that U.S. consumer spending is actually going to stay at least decent this year. we're still seeing a relatively strong labor market. Uh, the unemployment rate is a mere 3.5% for the December report. The economy is adding jobs at a pretty healthy rate. We're seeing another increase in employment for people on the margins of the labor force. So, as long as people have jobs, consumer spending is going to stay pretty good. The other thing that we're seeing, at least for the moment, is that mortgage rates have come down. Housing prices are, the increases in housing prices are slowing and in some cases declining. So those consumers who can buy right now are going to be entering the housing market earlier this year. So uh, I think the consumer sector is actually going to do okay.
All right, you sound relatively optimistic. FOMC then. Last year we had, as I recall, very few dissenting votes in the 8 policy meetings. This year, obviously, we've had the rotations coming through. Is it going to make it, you think, any harder, or will it make it easier for Mr. Powell to get his way in terms of the vote?
I think Mr. Powell is going to continue to see a fairly united FOMC. The group of policymakers coming in might be more classed as dovish uh, on monetary policy, but I haven't heard anything from any of them that really suggests that they're not all lined up behind a policy of getting inflation down, which for the Fed means raising interest rates, making monetary policy more restrictive.
Okay, certainly makes policy easier to sell if you can get away with that. Something else I want to ask you about before we move on: budget deficit. Does it matter anymore? I mean, we're going to have quantitative tightening continuing through this year, heavy government borrowing again. Is it is it going to be the kind of environment which is going to be a difficult one, do you think, for the bond market?
Well, I certainly think it's going to be a difficult one um, because that we've got a highly partisan and divided Congress. Getting any budget measure through is going to be long, hard battles. I think, at least in the House of Representatives, we're going to be seeing a lot of fiscal conservatives trying to put their stamp on the budget. So what that means for the future of borrowing in the markets is unclear to me, but it probably does mean we're going to go through a couple of those rather fraught episodes where we start talking about the full faith and credit of the U.S. again, and the absolute horror that would follow on any failure to properly fund the government, and that means borrowing.
So that was something I was going to ask you actually before we do move on, with Kevin McCarthy finally securing his speakership.
Uh,
As I understand it, you're not that far away from hitting the debt ceiling already. Do you think
yeah.
the kind of issues he had to perhaps compromise on in securing the chair, is it going to make it harder to get the budget deficit ceiling raised this year?
Yes,
In a
the short
nutshell.
answer.
Yeah.
Yes.
Okay.
I
Fair
mean,
enough.
just lining up the votes to get anything done is going to be really a tough call.
Right, that's not going to be good news for the bond market. Right, my last question to you then: any other big issues or even small issues which you think will be significant investors should be, keep an eye out on as we go through 2023?
Hmm. No, I think we've actually covered most of them. I think the most worrisome thing right now is we seem to be going through another wave of COVID, as you
Mm,
mentioned earlier, and it's probably not going to have a major impact on the economy, but it is a drag on what's going on to have these successive public health crises going on.
yeah, and maybe interested to see what Brian has to say in particular about China as we move on to him. Right, okay, thanks very much for that, Terry. Let's move across then to Max and Canada. Canada had a pretty good year last year, Max, didn't it? So what's your kind of prognosis for 2023? And again, same question to you really. What do you think of the kind of, the key issues that investors and our clients should be focusing upon?
I think, like Terry said, both Canada and the US, the labor markets are pretty tight. And what the Bank of Canada has been doing is to try to squeeze money out of some people's pockets, so that if they have to pay more on mortgage rates or other big item spending, then they wouldn't spend more on other stuff. So that's how they're trying to guide the economy. And as the governor had said, he would rather see over tightening than under tightening. So that means after the last rate hike in December, which was 50 basis points to 4.25%, I think people are expecting another 25 basis point hike and see how things go. And I don't think the bank is considering cutting rates towards the end of the year, in the new year, I mean 2023. So they just want to see how the core inflation rate is coming down as they wish, but it's still a long way down.
That was something I was going to ask you about, because Terry clearly seems to take the view that interest rates are obviously going high and also going to remain high in the States. I was going to ask you, I think there's actually a chance of out and out decoupling between the Bank of Canada and the Fed, perhaps towards the tail end of this year when we could see the first cut in BOC rates coming through. But from what you're saying, you still think that's unlikely?
As far as official comments and many economists' comments, I don't see a clear sign of that the rates will have to come down at the end of the year.
Okay, and let me ask you about the housing market, because for such a long time, what's been going on in housing has been one of the key issues, certainly that the Bank of Canada and the finance people have been looking at over there. Given the amount of tightening we've had coming through there already, are there issues in the housing market which could perhaps provide some downside surprises for the economy this year, do you think?
It's a bit of a complex issue in Canada because even though activity may be slower, prices are still high, in some spots rising. And it's making the younger generation extremely difficult to either rent or buy a home. And that, I'm talking about major cities like Toronto, Vancouver, Victoria, even. And there are still some speculators in the housing market, and we've been talking about a housing bubble, but if the bubble doesn't burst, maybe it's not a bubble, so it keeps going up. So that creates an issue of a central bank trying to bring the high prices down, but at the same time punishing the people who are trying to get home. So how does it work out for the overall economy? I'm not sure. Maybe there's some downturn, but it's a similar situation to the United States. If you hear all the comments from, for example, ISM Institute for Supply Management people saying maybe slower economic growth in the first half of 2023, but pick up in the second half. And nobody seems to be saying there's going to be a serious recession. So I think since Canada's economy is affected by the demand south of the border too, so those two economies seem to be going in a similar direction.
Okay, fair enough. Anything else we should be thinking about in terms of Canada this year?
I don't see any prospects of an election, but the prime minister is not very popular. So see how his public approval ratings go.
Okay, fair enough. Thanks for that, Max. Right, before we leave you, though, if we move across to Asia, now, if I've got my zodiac signs right, I think 2023 is the year of the rabbit. What I was going to ask you, though, do you think it could be the year of the yen as well? And we saw the currency spike significantly against the dollar when BOJ widened the target range on the JGB target back end of last year. If we do start to see the Fed sort of taking its foot off the pedal in terms of interest rate hikes, do you think we can actually see the yen start to strengthen as we go through this year?
I think the yen has already regained some ground, lost ground, but I wouldn't expect the yen to go back to 100 yen to the dollar or even below so quickly. Everybody's expecting this is a year of yen appreciation, and that's understandable. But keep in mind that the Bank of Japan is unlikely to raise rates in a true sense this year. So it's going to be hard for the yen to receive any kind of a support from policy or interest rate differentials at this moment.
Yeah, I think that's a fair point. I think it's quite often one of these things you mentioned, you kind of get the initial reaction to the fact that, oh, well, perhaps there's not too much Fed tightening to come now. And by the way, there might be quite a lot ultimately of BOJ to come. So you start buying the yen now. When the interest rate differentials remain very wide, you suddenly think, oh, perhaps it wasn't such a great idea in the first place. Having said of which, of course, we do get a new Bank of Japan governor this year. Do you think that might have any implications for yield curve targeting, or indeed any other aspect of monetary policy?
That's a very good question, and I would tend to agree with the observation by Kazuo Monma, a former chief economist at the BOJ, now with the private sector. He's saying the bank is actually not just targeting inflation, but more like wage growth. Mm-hmm. And he thinks they're not going to raise rates until wage growth tops 3% or reaches 3%. And if you take a look at the situation right now, inflation, this is CPI minus owner equivalent rent, and it's in November it was 4.5% year on year, which means even though total wage growth was 0.5%, real wages declined by 3.8%. So it's we are at a very low starting point, and even though some companies are giving their workers a temporary relief, giving more money temporarily, or others actually structuring into the salary scale to fight the inflation, we have to see probably 2 rounds of spring, which is April, wage reviews and changes. So that means this year may not be the year for the bank to raise rates, but it is likely that, as you can see, in 1 March they review the yield curve control regime, and I think they have to say why they hadn't met the 2% target yet. Mm-hmm. So they will be doing a lot of reviews, but I'm not sure if they're gonna quickly change the negative 0.1% on the short term and jack up the long term from current 0.5.
All right, softly soft as we go then. Okay, anything else we should be focusing upon for Japan?
Like in Canada, Japan's prime minister is not very popular. He seems to be hurrying.
Find one who is these days. Yes.
He's been criticized for just hurrying to boost the defense spending budget over 5 years, and everybody's asking, so how are you going to get the money? I mean, if you ask maybe people from Hong Kong, and they would say that's great because that's going to keep China maybe from expanding too much their naval power in Asia, Southeast Asia, but it's he seems to be a quiet guy, but he seems to be determined to do whatever he wants to do. And unlike in the U.S., the ruling bloc has a comfortable majority in both houses. So see how the rating's going to go, and how the LDP is going to fare in the spring regional elections.
Okay, brilliant. Thanks for that, Max. Right, let's move across then to Brian. I guess you've got some of the interesting countries this year, particularly China, with such a focus on that in terms of what's going to happen post zero COVID and its implications for global economy, commodity markets, and everything else. So I guess if we can start there, I know you may not be sort of a doctor or a virologist or whatever, but what's your kind of assessment about now we've had this reopening of economy, at least a good chunk of it anyway, but apparently we got soaring COVID cases. So do you think it's more like to be this kind of initial real nasty, something perhaps really nasty as people end up in hospital? We do see the death rate going up, hitting the economy, but due to the reopening, the second half of the year could be quite good. Or what's your kind of take on the most likely scenario?
I mean, it really seems like we're on a knife's edge at the moment. I keep thinking of was it Prime Minister Macmillan saying events, the boy events. We're really sort of at the mercy of how this is going to play out now that they've sort of bowed to public pressure, eased a lot of the restrictions, and it's sort of been their worst nightmare. That's just seen a huge spike in cases that's really creating, it seems, a similar amount of problems that was to the economy, at least, that we had when the restrictions were really tight. So it could go one of two ways, couldn't it? We could have public health conditions improve eventually. That there might be just this initial spike, and then things calm down, and then they'll be happy to keep those restrictions moving in an easier direction, or they'll see the spike and worry that it's not going to calm down, and then just put the brakes on again in terms of reinstating those public health conditions. So it's really in quite a very uncertain spot at the moment. And what is going to impact that even further is, of course, we're coming into this sort of blind spot in the data that we have every year as well around Chinese New Year. So in the next week or so, we'll get December data. So that'll be great. But then we're not going to get January data, a month from now, because they don't publish January data for most of the indicators. They combine it with January and February data. So it's not going to be until sometime in mid-March that we'll see actually how the economy has started at the start of the year. So there's just going to be a bit of a foggy situation for China in the next couple of months.
And I guess with the Lunar Year holidays, and I think I heard somewhere or other talking about, was it 2 million travels or something rather taking place across the country as people start to celebrate, which should, given COVID, presumably must increase the risk that we're going to see some nasty numbers coming out of this somewhere.
Oh, absolutely. And, they'll be mindful of that. And I think they'll be ready to, put the hammer down if they do think it's going to be a problem. And so, that just creates even more uncertainty. And possibly some real big volatility in the numbers that we're seeing, the economic numbers. So, it's just you're going to have to, I think, have a bit of patience and also a little bit of skepticism about what some numbers might show until we sort of get a clearer read, a little bit later. It's we always have this problem in January, February, how they combine those two months. But I think this year it's just going to be even more of an issue.
All right. To the extent we can put COVID on one side, which I guess, clearly we can't really, but we've had other issues such as, some of the big issues in 2022, the real estate market meltdown, ongoing trade restrictions, and, the political issues with the West and so on and so forth. Pull all that little lot together. We know that the government's thrown a fair amount at the economy already. Do you think they've done enough, say, ignoring COVID to turn it around? Or is it a case we're going to have to see more fiscal help and perhaps some form of easing coming out of the central bank as well?
I think they can tinker around the edges with some more policy measures to try and offset the impact of the public health conditions. But at the end of the day, I don't think they're going to be enough to really outweigh the impact on the economy that those restrictions and now the virus itself is having. They can help and maybe cushion the blow a little bit, but my view is really we're not going to see a very strong recovery in the key economic indicators until we have either the virus calm down and we don't need more restrictions. I think that's sort of the key policy variable at the moment is public health, rather than what bank lending is, or fiscal policy is. I think that's the main lever that they've got at the moment.
Okay, fair enough. One, again, it may be a slightly unfair question since we obviously don't know the answer to it. But in terms of, there's a lot of speculation about their Chinese attitudes towards Taiwan and what their end goal is there. Do you think that could become some kind of a blow-up area, for international politics and hence potentially financial markets this year? Or do you think it's perhaps been, it's too much talking on each side at the moment and nothing's going to really happen?
I mean, it's always a risk, and you've had quite bellicose statements from Chinese officials over the last couple of years. How what's going on in Ukraine impacts their thinking, I don't know. How they might be tempted to sort of rattle the sabers if economic discontent continues to grow in China. Who knows? It's not something that you would obviously like to see, and it's not something I think is the most likely scenario, but it's always going to be a risk that we have to take into account. The fact that they have made clear that they believe that they're entitled to as they say, reunite with Taiwan, and that's a standing policy of Beijing. That's something that they've got a right to do, but we just don't know if and when they'll ever exercise this right they say they have.
Right. Okay. Thanks for that. Right. Let's go to your home part of the world in Australia. I'm just quickly stick with China. I noticed there's been at least some reports on the wires of late suggesting that there's been the hints that perhaps there could be some thawing in the Chinese-Australian relations, and indeed possible that China might even end the ban on Australian coal. Do you think there is a genuine easing going on there? Because presumably, if so, that's got to be good news for the Australian economy.
Yeah, I mean, that's been in place since we had the change of government. What was it, back in May last year? The new Labor government has been, pretty keen to try and mend relations, which definitely did get pretty icy during the previous Australian government. Mm-hmm. And they seem to be having a bit of success there. And obviously, I think China is trying to use as much leverage as it can to and not make it too easy for the negotiators on the other side to get what they want. But they do seem open to trying to get back to where we were before. Obviously, China and Australia have had a very important trading relationship for a good 20 or 30 years now, and that has been disrupted, and it looks like it might be getting reinstated to a fairly back to basically where we were before.
Okay, right. Home economics then. Reserve Bank has increased interest rates by 300 basis points, remember rightly, since May, wasn't it? May last year. And It appears to be now doing what I guess it's supposed to be doing to the housing market. We've seen hefty fall in prices and I think building approvals. Do you think the housing market could be the kind of factor which might ultimately force the RBA to start trimming interest rates later this year, or is that still far too early to make that kind of call?
Oh, I mean, I think that's obviously one of the big factors that they'll be looking at. But the main goal obviously is to get inflation back to a reasonable level, and so I think they'll be guided by what the inflation number in particular and the wage number is showing in particular. And so they put out their most recent forecast back in November, and they think inflation is peaking around about now, whether it's last month, this month, next month, sometime around now, and then dropping reasonably sharply over the course of the next 12 months, but still being well above where they want it to be. So they've also been very conscious, though, that their track record of forecasting inflation over the last couple of years has not been great.
Join a very big club, yes.
Well, exactly, yes. So I think that's making them a bit wary about just how quickly they can return to more stable monetary policy. But that's clearly going to be the main thing that they're looking at, and of course they're and we're seeing this right across the board by policymakers. They're expecting, some more action from the Fed, expecting, a slowdown in the US economy. That's, I think, the consensus among policymakers in this part of the world. They're not expecting the euro area to give much of a boost to global growth. And and we talked about China before. They're thinking that the Chinese economy is still not going to provide a lot of support. So that's factoring into the decisions as well.
Okay, fair enough. Anything else particular on Australia before we move across perhaps to New Zealand?
No, I mean, we also have a bit of a gap in the Australia data flow because the RBA doesn't meet in January. They take January off. So
Right.
We'll see what they say in early February, and then they'll also be putting out their quarterly monetary report in February. So keep an eye out for that. But I think we've still got a bit more of rate hikes coming from the RBA, but they will be hopeful that base effects and sort of slow world growth will start getting that inflation number down over the course of this year.
Okay, so that's in terms of central banks, as we've mentioned on various other podcasts, the RBNZ being amongst the most aggressive. Do you think we're getting near the top end of RBNZ rates? So we still got some way to go. I guess the last sort of policy meeting sounded pretty aggressive still, didn't it?
Yeah, they're probably a little bit more aggressive than the RBA. I mean, I've got the chart right in front of me of their inflation forecast relative to the RBA inflation forecast, and it's a very similar profile. They're thinking inflation is peaking around about now and falling pretty sharply over 2023, but still being above where they'd want it to be. So it's a very similar profile, and that does suggest a reasonably similar policy outlook. Still some more to go, but they're probably hoping that they can start they can start pulling back on aggressive rate hikes at some stage this year.
All right, I think we've got a general election coming up in New Zealand, haven't we? Is that expect to have any implications for policy?
I don't think it'll have much of an impact on the RBNZ. They have a pretty independent framework in place for monetary policies. So obviously, if there was a change in government and a change in fiscal policy, that would factor into their decisions. But I wouldn't expect that to be a major influence on what the RBNZ does.
Okay. Anything else in terms of New Zealand we should be thinking about?
No, again, they're just, I think, watching China, watching the Fed, watching energy prices, pretty much the same as all of us. But as I said, I do think they will be in a position, later in the year to start scaling back the real, aggressive policy tightening.
Okay, before we just quickly round up on the rest of your part of the world, you mentioned India. I think it was at the United Nations pointing out that sometime in 2023, I think they were saying April, India will officially overtake China as the most populous country in the world. Do you think that's got any implications for just how significantly markets start to view Indian data? Because by and large, broad terms, yes, perhaps they tend to look at it. Obviously, I look at what the RBI is doing, but otherwise, by and large, they tend to be very much secondary numbers. Is this the kind of part of the market which investors now start to be looking more at, do you think?
Perhaps to a certain extent, but I think probably the reason why India doesn't get as much focus as China is just a less sort of global economy in terms of its the share of exports as a total GDP and right. Foreign investment and sort of other connections with the rest of the global economy. India is a bit more sort of self-contained relative to China, so it doesn't have those same linkages, particularly on the trade front that China has. So I think that's probably the main reason it doesn't get as much attention as China. So if it's a little bit bigger than China, that I think will get that will be an interesting little fact for people to take into account. But just the relative importance of the global sector on its economy is not as much as what it is for China.
Fair enough. Anything else from your part of the world, the countries that you cover, Brian?
Well, I think also, just talking about India, just the outlook there. Again, they still have inflation above where they want it to be, and so far, they haven't seen a really big slowdown in some of the key economic activity indicators. So I think they do expect to still keep with a bit more tightening going forward. So it's a pretty similar pattern to the rest of the region. Inflation. I think if you could summarize most of the region in the same way. Inflation, they're hoping will come down a bit, but they've still got a little bit more tightening to go. I think that's probably the common theme for most central banks in the region.
Okay, great. Thanks a lot for that, Brian. Right, let's wrap this up then. Quick look at Europe. What did we say about Europe? Well, for most of the central banks, be it like the Bank of England, the ECB, or some of the smaller European central banks, focus is still on inflation, and particularly labour markets as well, all of which remain very tight. And the other key point, I suppose, to mention with regards to inflation, increasingly the central banks are focusing upon the core rate. As we talked about previously, we're going to see most headline rates, not just in Europe, but probably globally, tending to at least drift low, in some cases come off quite sharply during the first half of this year due to base effects caused by the sharp increase in energy prices last year, and indeed some fairly significant softening in energy prices we've seen over the course of the last month or so. Now that's going to mean then that we will see declining headline inflation rates, but of course the central banks are concentrating upon underlying picture of the so-called core rates. Indeed, that was particularly noticeable in the last set of European figures for the flash numbers for December, which showed a surprisingly sharp fall in the headline rate, but the core rates actually accelerated. So if anyone thinks that that's going to make the ECB less likely to raise interest rates next month, I can pretty well guarantee they're wrong, and we'll almost certainly see interest rates going up out of the ECB anyway. I expect at least twice, both in February and at the meeting after that. For otherwise, it's clearly Ukraine still very much the dominant factor as far as Europe is concerned. Indeed, it looks likely to stay so, with both sides of the war at the moment apparently are willing to compromise in any form of peace talks, assuming they can actually get to the peace talks in the first place. Seasonally warm weather in Europe. We've seen temperatures, I guess, on average about 4 degrees or centigrade or so higher than we saw this time last year. That's had the impact of cutting energy demand quite significantly. And that certainly helped to push prices down. I mean, Germany, for example, total gas storage levels, I think it's about last week, almost about 91% or so. Gas consumption was down 30% over the last month or so compared to a year ago. So far, at least it looks as if atmospheric conditions, if you like, have been very favourable to helping to reduce oil prices, which is certainly going to be a favourable factor for the headline inflation rates upcoming. But do keep an eye on the core rates. We don't have any elections coming up in terms of the big countries of Europe as far as 2023 is concerned. There will be some in the likes of Greece, in Finland, but they're unlikely to have any big impact in terms of investor sentiment. But do keep an eye on some of the state elections in Germany. They'll be taking place in February, May and October, and also there'll be a Swiss federal election in October at the back end of this year as well. On the whole, though, I wouldn't really expect them to have too much of an impact. In terms of ECB policy in general, I mentioned, do keep an eye on what's going on with core inflation, but also the labour market as well. A lot of the central banks over here keep making noises to the fact that labour markets are very tight, and that, of course, makes for upside risk as far as wages are concerned. We don't really get decent, up-to-date wage data out of continental Europe, so it means keep an eye on what's going on with the unemployment rate, and indeed also to some extent the supply of labour as well, which remains an issue for a lot of these companies who are struggling to get new staff in. What else can I say? Well, I guess in terms of the actual ECB itself, most of the comments coming out currently do suggest that by and large the hawks remain in the ascendancy. I think a number of the doves, notably including President Lagarde, seem to have kind of thrown in the towel with regards to suggesting that the interest rates don't have to go up too far. So I mentioned earlier, expect we'll probably get at least another 50 basis point hike in February, and probably another 50 basis points at the March meeting as well. Other things to watch out for as far as continental Europe's concerned this year. As I mentioned, the US, there's a lot of supply coming up there and budget deficits could be an issue. That's also true of Europe as well. In Germany, for example, we're going to see a record volume of debt being introduced in 2023. Around about, I think it's 550 billion euros. That'll be up from about 450 billion in 2022. So if we do have, still strong core inflation and rising ECB interest rates, it could be a difficult time for European bond markets. And if that's the case, then we're probably going to see some pressures coming through again on a number of the Eurozone marginal countries, I should say, obviously with the main focus on Italy. That's not coming through in terms of bond spreads at the moment, but if we do see bond yields start rising again significantly and the short end of the curve going up as well, it could certainly become an issue. And indeed, already we're starting to see some of the mix across Europe where the more vulnerable countries are susceptible to higher increases in their bond yields. Some of the political fallout coming from that. In Italy, the new Prime Minister Meloni's, her right-wing administration, they're already questioning the legitimacy of ECB independence following their announcement at the back end of last year that they'd be starting quantitative tightening this year. They don't like quantitative tightening, and of course, if we do see it starting to put upside pressure on bond yields, it could become more of a widespread issue for Europe, particularly if we see the recession being generally expected recession being deeper than currently anticipated and the ECB doesn't respond to. On that front, I should say at the moment, most of the data kind of suggests that although there's certainly a chance we'll see the Eurozone falling into recession in 2023, there's not too much around at the moment to suggest it will be a really significant recession. Indeed, Germany started to pull up a little bit better than expected of late. The ECDI, we watch out economy, they've also started to move back into positive territory. So it's not going to be a good year, almost certainly for continental Europe as a whole, but it may not be perhaps quite as bad as some investors are currently anticipating. For the UK, well, I guess everyone's assuming that 2023 is going to be a terrible year for the UK economy, and I guess with good reason, really. Think about there's almost certainly going to be a record fall in real disposable incomes, double-digit inflation for quite a long while. We got nationwide strikes, we got Brexit still stifling EU trade, an economy that's probably already in recession. Add to that a government lacking policy credibility, and you've got to kind of think, why would anyone want overseas to fund the UK current account deficit? But bear in mind that when everyone's looking the same direction, more or not often than not, it tends to be wrong. So I can't help wondering if some of this bearishness might be a little bit overdone. In terms of what to watch on the numbers front, again, the labour market hugely important in the UK and wages for the Bank of England. But indeed, in line with sort of a lot of European countries, labour supply, I suspect, is going to become more and more of an indicator. For the UK, the workforce is down around about 500,000 or so since the start of COVID. And it's been the shortage of particularly skilled workers during the recovery process, which has helped to ensure that the upswing in UK GDP has been the weakest, certainly amongst the G7 countries anyway. So do keep an eye on the size of the labour force and the participation rate when we get the monthly labour force reports out, because the banks will be looking at that closely with a view to being kind of a leading indicator of what's going to happen to wages, which of course is so important when they're trying to work out what's going to happen to the inflation numbers that they're actually trying to target. What I was going to say in terms of other bits and pieces, there's an awful lot of strike activity in the UK, which the government is trying to sort out at the moment. Estimates from at least some business surveys have suggested that the current industrial action at the rail workers are costing probably around about £1.5 billion to the UK economy at the moment. And that's going to hit government taxes by about 600 million or so push up the public sector deficit. So either we're going to see the government give way on wages, which will also boost the deficit, or we're going to see these strikes going on, which will continue to hit the deficit anyway. So it could well be a difficult year as far as the UK gilt market's concerned, particularly with the Bank of England still expected to raise interest rates. For choice, I suspect the market may be a bit too bearish on UK interest rates, given the way the UK economy seems like it's going to perform at the moment. But in any event, it's probably going to be a difficult time for the bond market over here. Other bits and pieces I should quickly mention. On a brighter note for Brexit, there have been some early talks on the Northern Ireland Protocol, this huge sticking point over the whole Brexit issue in the first place. It does look like there's been some actual genuine progress there, and there's hope that there may be some kind of new trade deal being announced within the next, well, certainly the next month or so anyway. Were that to be the case, that could certainly be a useful plus for the pound. And at the same time, the hopes from Scotland, from the Scottish National Party, that there would be a second Scottish independence referendum in 2023. That, as a result of the Supreme Court ruling at the back end of last year, looks to have been stamped on. Nicola Sturgeon, the First Minister of Scotland, still hopes to hold a second referendum in 2023, which, of course, if Scotland won, that could be seriously negative for the pound. But it looks like it's now unlikely to happen. But in any event, keep an eye on it anyway, because it could have a big impact for, well, both sterling and UK markets in particular. Anything else from my side? I should quickly mention Switzerland. I guess almost more than any other central bank, inflation dominates Swiss National Bank policy to the extent that the kind of Swiss franc levels we have at the moment, not very long ago, would have been seen as being hugely overvalued by the SNB, but now they're welcomed as an aid to helping to keep inflation down. We've seen inflation fall in Switzerland in 3 of the last 4 months, but a bit like the Eurozone, core inflation is still rising. The labour market remains very tight. Indeed, keep an eye on that, as ditto with as far as the UK is concerned, because the Swiss National Bank looks at that with a view to tightness and inflationary pressures in general. Our latest figures out of that were again very strong. So it looks as if we'll still get the SNB raising interest rates, even though inflation is actually heading towards target at the moment. The other thing that's mentioned is that the Swiss National Bank has been selling, well, bucket loads of foreign currency to shrink its balance sheet over the course of the last few months. And that hasn't had too much of an impact on the Swiss franc. Should the Swiss franc really start to strengthen again and the sales stop, that could signify that, well, the franc's reached the central bank's new pain threshold, whatever that might be. So do keep an eye on the weekly monetary policy data released by the SNB for signs that sight deposits, a proxy for intervention, may no longer be going down. Right. I guess that's probably enough out of Europe. Has anyone else got anything else they'd like to put into the pot before we round this little thing up?
Jeremy, it's Max here. I have a kind of a global question for everybody. What we've seen is because of the higher interest rates and the shrinking demand and shrinking international trade volumes, and if people are still expecting an eventual recovery of all those economies, are we talking about the countries and economies trying to depend more on regional and domestic demand, and at the same time, as Bank of Canada policymakers admitted that they underestimated the impact of a global supply chain constraints on inflation and growth. So, and we've seen some companies have been moving factories out of China, first because of the US-China trade war, but also the latest fiasco of supply chain disruptions. So, obviously countries like Indonesia, Vietnam, even India, Thailand will benefit from it, and maybe already. So what's going to happen to production, consumption, and employment for those countries? And Japanese are also shifting factories back to Japan because of high costs due to the weekend. So is that a kind of a similar trend going on to the States and Europe too?
Well, certainly from my side, I'd say yes. I think as a result of what's been happening, partly through COVID, but particularly as far as Europe's concerned due to the war in Ukraine, there's more and more determination to try and source as much as possible domestically. But the problem with that being, of course, is there's A, limited supply, and B, it takes time to do it. So I think it's one of those long-term structural shifts, which might well mean that inflation stays that much higher than perhaps people anticipate at the moment, because we don't have the investment in the supply chains yet that are necessary to get supply back to where it was. So the worries, I think one of the worries for the central banks at the moment is that they're raising interest rates with a view to pulling down demand, which they appear to be doing successfully, but they really need to see the supply side of a global economy pick up at the same time, and we're not really seeing that at the moment. So yes, I think you're right. You're very much right to mention it. It's one of the big issues. Yeah.
Yeah, and we've got a similar issue in Australia. Just in the news this week, shortages of antibiotics is a real concern, and some talk that maybe we should be reinstating some of our manufacturing so that we do have some key key products available when we need them. And I think a similar situation is happening in the US. Shortage of certain drugs is an issue. So I think the whole experience of the last 2 or 3 years is really prompting a reevaluation of supply chain vulnerabilities.
Yeah, I think globalization was supposed to be one of the means of helping to keep prices down, but presuming the same kind of argument, deglobalization or re-domestication is start pushing prices back up again. Fair point. Good one, Max. Anyone on for anything else? In which case, let's end it there then. So I guess, well, lots to think about in terms of 2023, and you can bet your bottom dollar or whatever currency you fancy, there'll be some big surprises somewhere over coming months. So do remember to keep up to date with all the key market moving data and events in Econoday's global economic calendar. On which note, simply remains for me, on behalf of everyone at Econoday, to wish you, all our listeners, a happy, safe and a profitable new year. Thanks for joining us today. Hope to see you next time. Bye for now. Strategic investing and analysis are a lot easier when you can identify patterns and see how economic events and announcements correlate with specific market movements. The Econoday Investors Journal provides a convenient and easy way to follow important economic events every day, every month throughout the year. View the most important market moving events for the upcoming year in a glance. The Econoday Investors Journal is your essential desktop resource for economic events and indicators, FOMC meetings and announcements, US banking holidays, equity settlement dates and more. The Econoday Investors Journal is much more than a financial calendar. It's an indispensable tool to help you anticipate active days in the market. Learn the intricacies and interactions of the market, record daily market activity, and explore helpful insights from experienced market analysts. Take advantage of our informative resource centre, which includes a comprehensive glossary of need-to-know terms, clear, concise information on policy and historical trends, useful graphs, and a guide to the influencing factors and people to watch at the Federal Reserve. Order your Econoday Investors Journal now at shop.econoday.com.